Welcome to this explainer. Okay, we're diving right in today because we've got to talk about the absolute roller coaster that is Accenture's stock, ticker symbol ACN. We're tracking a massive crash, followed by this incredible 26% monthly rebound that honestly has Wall Street totally divided right now. There is a serious tug of war happening with this stock, and we're going to break down exactly what's driving it. So whether you're looking for a rare tech bargain or just trying to avoid catching a falling knife, this is basically a masterclass in market psychology. So here's the $113 billion question. Is this consulting giant actually a rare generational buying opportunity? Or are we looking at a classic value trap just waiting to snapshot on folks who think they're getting a discount? That's exactly what we're going to figure out together. To really get this, we've got to look at the sheer scale of the devastation here. I mean, we're talking about a brutal 54% nosedive from its 52-week high of $291, cratering all the way down to a low of just $118. Even with the recent outperformance over the last month, where it bounced back to around 185 today, it's still down over 27% from its peak. It has been an absolute wild ride for shareholders. And this crash, it completely crushed their valuation multiples. Their trailing 12-month price-to-earnings ratio is sitting just under 14.8, and the forward PE got dragged all the way down to a rock-bottom 12.5. To put that into perspective, their historical norm is usually up around 25. Basically, the market is screaming that a severe, sustained slowdown is coming. But, we have to ask ourselves, is that slowdown already fully baked into this dirt-cheap price? All right, Section 1, the Q3 earnings shock. Good numbers, bad outlook. To figure out why those multiples just vanished, let's rewind to June 18th, 2026, because man, that was a massive plot twist. Because, on paper, the fundamentals actually looked fantastic. They pulled in $18.72 billion in revenue. That's a solid 6% jump year over year. They beat earnings at $3.80, expanded their operating margins to 17%, and literally churned out $3.6 billion in free cash flow. For a company this huge, those are undeniably remarkably strong numbers. And yet, the market completely panicked. The stock plummeted 18% in a single day of trading right after the announcement. So, what gives? How does a solid earnings beat and billions in cash trigger an 18% freefall? Well, it was all about the future. Management slashed their guidance, and the panic set in. CEO Julie Sweet pointed to a couple of huge speed bumps. Roughly $100 million in lost revenue from conflicts in the Middle East, plus some really large managed services deals that got pushed all the way out to fiscal 2027. Because of that, they cut their full-year revenue growth outlook to a measly 3 to 4%. Investors got totally spooked, thinking an enterprise IT spending freeze was underway. And as we all know, the market absolutely despises uncertainty. Moving on to Section 2, the multi-billion-dollar pivot into cybersecurity and AI. This is where the story gets super interesting for long-term investors. Because Accenture, they're not just taking this sitting down. They are fighting back with an incredibly aggressive bet on the future. Literally on the exact same day they dropped those earnings, they announced a massive expansion into operational technology cybersecurity. Now, OT isn't just about protecting your data. It's about locking down physical infrastructure like power grids and pipelines. They grabbed a majority stake in Dragos and fully bought out runZero and NetRise. That's a $4.175 billion combined enterprise value right there. These companies bring in $208 million in annual recurring revenue, and they're growing at almost 50%. Accenture is clearly positioning itself to completely dominate an industrial cyber market that's projected to hit $60 billion by 2031. At the exact same time, they slammed the gas pedal on their AI pivot. They bought a UK-based firm called Faculty and actually made its founder, Dr. Mark Warner, their new chief technology officer. This move pushes their total army of AI and data professionals to an unbelievable 85,000 employees. Just let that sink in for a second. 85,000 highly trained people focused purely on AI and data integration for their clients. And hey, management is telling us this strategy is already paying off. Bookings from AI partnerships with absolute heavyweights, think NVIDIA, OpenAI, and Palantir, they're currently on track to double from their fiscal 2025 levels. Accenture is steering hard into these high-margin recurring revenue streams to totally future-proof the business model. Which brings us to Section 3, the Wall Street War, bulls versus bears. This aggressive pivot during such a weird macroeconomic environment has kicked off a massive, incredibly polarizing fight on Wall Street. Price targets are literally all over the map, swinging wildly from $130 all the way up to $275. That is a crazy spread. So let's put these two sides in the ring together. We really need to unpack what's driving the value trap pessimism on one side and the deep value optimism on the other, so we can actually cut through all this noise. Let's start with the bears. Analysts over at Morgan Stanley are sitting on a hold rating, which, let's be real, is often just Wall Street speak for don't touch this, with a $130 price target. They argue that when the global economy even hints at a recession, consulting budgets are the very first thing to get chopped. They look at the slowing growth and those ongoing geopolitical risks in the Middle East and say, nope, the structural pain isn't over, the worst is still coming. But on the flip side, the bulls, like UBS with their shiny buy rating and $275 target, they think this sell-off is massively overblown. I mean, look at the metrics they're pointing to. You're buying a market leader with a 24% return on equity for a ridiculously cheap 12.5 forward PE. And the best part? A massive 11.7% free cash flow yield. Basically, they are printing a mountain of leftover cash just to reward shareholders. For context, the S&P 500 median is only like 4.2%. So yeah, you're literally getting paid to wait, especially when you factor in a 3.7% dividend yield and a brand new $2 billion share buyback program. All right, Section 4, the Q4 catalyst, what to watch. This whole Wall Street tug of war is barreling toward a massive climax that's going to decisively prove one of these sides right and the other one dead wrong. The clock runs out right here, October 1st, 2026. That's when Accenture drops its pre-market Q4 earnings report. This single date is the ultimate catalyst for the stock's next big move. Literally every analyst and investor is holding their breath waiting for this pre-market release. The target they've got to hit is pretty clear. Management guided for Q4 revenue to land somewhere between $17.75 and $18.4 billion. If they can hit the top end of that, $18.4 billion, that powerfully signals client spending is stabilizing. It potentially validates the bull thesis, and we could see the stock gap up. But if they miss that bottom end, control gets handed right back to the bears. The deceleration fears are confirmed, and we're probably looking at a retest of those recent lows. And let me tell you, the internal pressure to hit those numbers is off the charts. CEO Julie Sweet actually sent out this highly unusual internal memo, flat out asking employees to find more ways to create more revenue. She even let staff roll over their vacation days just to keep them at their desks to secure a strong year-end print. I mean, that shows you exactly how high the stakes are right now inside the company. They're pulling out absolutely every stop. So I'm going to leave you with this to chew on before October 1st rolls around. Does this incredibly aggressive pivot into AI and cyber make Accenture a true generational buy at $185, considering that historically low valuation and massive cash flow yield? Or is the harsh reality of an IT spending slowdown and delayed contracts going to drag this thing right back down to $130? Basically, is this upcoming earnings report going to be a trick or a massive treat for investors? Thanks for hanging out for this explainer. I really hope it helped make some sense of this crazy tug of war happening with Accenture right now.